This is On the Market, a Bigger Pockets podcast presented by Fundrise. Hey everyone, welcome to On the Market. I'm your host, Dave Meyer, and today is going to be one of those episodes where I fanboy a little bit. We have an economist who I've been following for many years and is one of the more respected, reputable economists in the country, Mark Zandi from Moody's Analytics. He's been covering the housing market and economics for Moody's, which, if you don't know, we've had a couple of their guests on. It's just a big analytics economics firm that does a lot of original research. And Mark is one of their lead economists. And today we go into an incredible conversation with him about all sorts of things. We start and talk about the banking crisis, and Mark provides some really helpful, insightful information about what is going on, why certain banks are at risk and other banks aren't, if he thinks this is going to spread, what he makes of the government intervention. And then we get into a really good conversation about how this is going to impact the economy as a whole, whether we might go into a recession. And of course, at the end, we talk a lot about how the banking crisis, and yes, it is still unfolding, but based on what we know right now about the banking crisis, if and how that is going to impact both the residential and commercial real estate market. So this is one of my favorite shows we've done. Mark makes complex economic information really easy to understand, and he really does a great job shedding light on the particular strange economic climate that we're in today. So we're going to take a quick break, and then we're going to get into our interview with Mark Zandi, who is the chief economist of Moody's Analytics. Mark Zandi, welcome to On the Market. Thank you so much for being here.
It's a pleasure, Dave. Thanks for having me.
Well, I hope you're not too tired of talking about the banking crisis just yet, because that is what we were hoping to pick your brain about.
No, it's not all that anyone wants to talk about, including my 90-year-old dad and mother-in-law. So it's the top of mind for sure.
Well, yeah, I think that's true for myself and for a lot of our listeners. And we did do a show last week sort of talking about what happened specifically at Silicon Valley Bank and what some of the decisions and macroeconomic factors that led to that. But I was hoping to just talk to you in general about the U.S. banking system right now and how much risk you see in the overall sector.
Well, in general, I feel pretty good about it, right? Because of the post-financial crisis reforms, the banking system in aggregate has lots of capital. Capital is the cushion, the cash cushion that banks have to digest any losses that they might suffer on their loans and securities. And it's records amounts of capital, particularly for the big guys, the so-called GSIBs, the globally systemically important banks. They got capital everywhere. Plenty of liquidity, generally, and pretty good risk management. So credit quality is excellent. I mean, if you look at delinquency and the charge-off rates, they're very low. They're starting to push up a bit, and they're getting a little worrisome for bank cards and unsecured personal lines, which we can talk about. But generally speaking, the quality is good. So, I would have said the system's in very good shape coming into this. Now, obviously, it's under a lot of stress, given the increase in interest rates, which have been very significant over the past year, and given the shape of the yield curve. That's the difference between long and short rates, because that's what determines banks' net interest margins, their profitability. They are under pressure, and you can see that in the banking crisis that we're suffering now. But generally speaking, the banking system is in good shape, about as good as I've seen it, coming into a period like this.
That's really helpful context, because it doesn't necessarily feel like that. And I want to ask a follow-up question about that. But first I wanted to ask, you said something about GSIBs, which everyone is probably learning this acronym all at once. Global systemically important banks.
Yep.
You said that they are in particularly good shape. Is there a reason why some of these smaller and mid-tier banks are seeing, particularly their stocks decline or have at least a higher perceived risk than these GSIBs, which I think for our audience are huge banks like Chase and Wells Fargo and Bank of America kind of banks?
Yeah. One of the big differences is just the amount of capital and liquidity they hold. Because the G-SIBs were deemed to be systemically important, meaning if they fail, they're going to take out the entire system. Regulation post-financial crisis, Dodd-Frank is the legislation that was passed in 2010, requires those big guys to hold a boatload of capital. I mean, just to give you context, you add up all the capital, again, that's that cash cushion I mentioned earlier, it's over 20% of their assets. That's more than double what it was before the financial crisis. So those guys are, almost financially meteor-proof. I mean, because we're so worried about them going under. The little guys, not so much. And in fact, some of those Dodd-Frank reforms that were put into place back in 2010 were rolled back for institutions that were less than $250 billion in assets. Silicon Valley Bank grew from a $50 billion to a $200 billion bank, very, very quickly. So they never got into that tougher regulatory regime. So they had less capital, less obviously liquidity, less oversight, regulatory oversight. We'll have to learn more exactly what happened here and, a good root cause analysis. But, at core, because they didn't have the capital and liquidity, they were more vulnerable to the kind of the bank runs that, they're suffering and why they failed. So they just didn't have the same resources, the big guys had, and the same kind of rock solid underpinnings to their finances that the big guys have, in large part because of the changes after the financial crisis back a little over a decade ago.
Great. That's super helpful. Yeah, and I think it helps our audience understand why certain types of banks are seeing more risk and more fear surrounding them than others. You made some great points about why the banking system itself is in relatively good shape. Can you help us square the situation we're in then? If the banking system is in relatively good shape, why are we seeing banks fail? And I think we've talked about that a little bit on this show, but why is there continuing risk and fear about the banking system right now?
Well, the banks have failed, or very what I call idiosyncratic, right? There's been three failures: Silicon Valley Bank, Signature Bank, and Silvergate. Silvergate failed a few weeks ago. Silvergate and Signature, they're just crypto banks. I mean, they cater to the crypto craze, which was highly speculative. Lots of warnings about that market for a long time. Not surprising it crashed, and it took out those two banks because they're so intimately tied up in what was going on in the crypto market. In the case of Silicon Valley Bank, they're tied into the tech sector. And as we all know, the tech sector is under a lot of pressure for lots of different reasons. You even saw today Amazon, laid off another 9,000 people. So the tech sector is under a lot of pressure, especially the small startup tech companies, right? Because, they need capital to keep going because they run cash flow negative. They're burning through cash. So they need constant, new equity raises, new debt raises, new capital to function. And when the tech sector hit the skids, they couldn't go out and raise more capital, and so they were increasingly vulnerable. Their deposits were starting to run down and making the bank increasingly more vulnerable. So I think SVB is just more Silicon Valley Bank. I'll use that going forward. It's just a lot easier to say. Was really tied into the tech sector and got nailed by the tech bust. More broadly, there is the vulnerability is the fact that interest rates did rise a lot, and what happened was with those rising rates, it makes the value of the treasury bonds and mortgage securities that all banks own worth less. So if a bank is in a position where they have to come up with cash to pay off a depositor and have to sell those securities, and they haven't hedged, that risk, meaning they haven't offloaded that risk into the marketplace for a cost, then they're vulnerable, right? Because they need the cash. They're selling these securities at a loss and taking big losses, and they may not be able to fill the hole. So the system as a whole, that's where the vulnerability is. But I think in general, again, going back to my original point, I think that risk is generally manageable across the system. This is not at all a surprise. This was, well understood, and most banks are very careful about their so-called asset liability management. That's what this is, and hedged a lot of that, risk. So I don't view the banking system writ large at significant risk of that threat. But that's the one vulnerability that it has. And the other banks that have failed, they're, again, very idiosyncratic, tied into what's going on with crypto and tech.
In addition to the risk that you just cited of the value of some of these assets and securities going down, what risk of panic is there? Because it seems to me that a lot of the risk comes from human behavior and psychology and not necessarily the bank's balance sheets.
Yeah, that's a great point. And that may be something that's different this time than in times past. That, people, not that human nature has changed. That as we know, Dave, that never changes.
Yeah.
That never changes. That stays the same. And people are always, subject to these kinds of concerns. Remember Jimmy Stewart, Wonderful Life? Bank runs have been around since the beginning of time, since the beginning of banks.
Someone else was talking to me about that. It's a Wonderful Life.
A great movie.
If only George were there to solve the bank run, we'd all be okay.
If only he was here. Yeah, if only. So that's the same. But what makes this time a little bit different, maybe more than a little bit different, is how quickly people's concerns can get amplified through social media. And that kind of sort of what happened here with the case of Silicon Valley Bank. There's, lots of stories about, some of the investors and depositors and customers of the bank, publicly tweeting out that they're getting out, and anyone who has anything to do with the bank should get the hell out. Well, get out. And I'm sure they said it in stronger terms. And, that went viral. And so you amplify these kind of concerns and risks. You go back to 1932 and that bank run, Jimmy Stewart, Wonderful Life, you obviously didn't have any of that, right? I mean, it was a community that kind of the angst fed on itself, not kind of a global, social media platform amplifying these concerns. So that raises some interesting questions about the future and sort of how we have to think about these bank runs and what regulation needs to be put in place to alleviate the potential risk posed by these bank runs of the future that are, again, amplified by social media. I'm not sure I have an answer to that question, but that's a question I think we should start asking ourselves, going forward. Maybe because of social media and just the amplification of these worries, we're going to see more bank runs in the future than we have historically, at least since deposit insurance was put on the planet back in the 30s.
That makes a lot of sense about the social media component. And one of the things that I've been wondering about is I have limited but some experience in the startup and venture capital world. And it seems to me that part of the issue here was just the nature of how those businesses, investors work together, where these startups get all their money from a pretty small investor pool. I mean, there are probably hundreds or thousands of venture capital companies, but not, the big influential ones. There are several dozen, and they have so much power in that scenario where, maybe a couple of dozens of venture capitalists can send out emails telling companies that have billions of dollars worth of deposits to withdraw their capital. And I can't think of any other industry that has that type of power concentrated in just such a small amount of people. But to your point, that plus social media just creates this weird scenario where panic can spread so quickly.
Yeah, no, absolutely. Yeah, I totally agree with you. I mean, again, it goes back to my point that it feels, I keep using the word idiosyncratic. It's just unique. It's different. It's not your tradition. It's not your mother's and father's bank. It's a very untraditional bank with a very different set of customers, and with their own kind of issues that created this. I think this situation that we find ourselves in.
Yeah, absolutely. So I know you have no crystal ball, but I do have to ask.
I've got 3, by the way, Dave. No, I didn't say they work. I don't know if they work, but I got 3 of them. Yeah.
There you go.
Yeah.
Well, I'm curious what you think will happen from here. The government has obviously stepped in. A few different agencies have stepped in to try and stem the crisis. Do you think what so far the Fed and the FDIC has done to reassure depositors is enough, or do you think there's more uncertainty and potentially more bank failures or an extension of this crisis in our future?
Well, I think the policy response has been impressive, massive, very different from what happened in the financial crisis. It took a long time for policymakers, the Fed, the FDIC, the Bush administration at the time to kind of kick into gear, in part because they hadn't experienced anything since the 1930s like that, and so they just, it was just all new. But this go around, very aggressive response, guaranteeing the deposits of all depositors, small and big, in the institutions that failed. And my sense is, if not explicitly, implicitly suggesting that if another failure occurs, those depositors will be made whole, again, small and big, in the current environment where they're concerned about systemic risk and bank runs. The Fed set up a credit facility to provide liquidity to the banks. Those Treasury mortgage securities I talked about earlier, they're sitting on the balance sheet of the banks at a loss because of the run-up in interest rates. The banks can go to the Fed, post those treasuries and mortgages as collateral for a loan at par, so that as if they're not have not lost any value. They got to pay a high interest rate for that, but that's no big deal. I mean, to meet deposit demands. And of course, the government has stepped in to resolve the weak links in the system, either through shutting down institutions. We've talked about SVB and Silvergate and Signature, or merging that's weakened institutions into stronger ones. That what we saw over the weekend when UBS, the big Swiss bank, took over Credit Suisse, the troubled bank, which was troubled well before all this mess, but got pushed over because of this mess. And then organizing other banks to come in and step up and help banks that are in trouble. That would be the First Republic case. So the government is taking very aggressive steps to kind of take those idiosyncratic weak links out of the system, putting them over there so that people feel comfortable that the bank that they're doing business with is money good and they're going to get their deposit out. So I feel very good about that. If I were king for the day, there's a few other things that I kind of be thinking about. Like there's a big decision the Fed's got to make, here in a couple of days around interest rates. And there's a reasonable probability they're going to raise rates another quarter point, which I just don't get, in the context of this banking crisis. I mean, 1 week you're setting up a credit facility to provide liquidity to help take pressure off the banks, and then the next week you're going to raise interest rates, which will put pressure on the banks. I have a hard time squaring that circle. So if I were, on the Fed, I might have we'll have to see what they do. But I fear they're going to raise rates. In my view, that would be a mistake, but let's see what they actually end up doing here. And also, in terms of the guarantee provided to depositors, that's institution by institution right now. It's not a blanket, if someone fails, those depositors are going to get a guarantee by the government. I'm not so sure I would have done that in the current context. Again, I think this is an environment where bank runs are very, very possible, and you want to make people very confident. I would have just said, in this systemic environment, and I labeling this a systemic environment, it's temporary, but here we are. I will guarantee all deposits of any failed institution, just to put anyone's mind at rest. My 93-year-old mother-in-law's mind at rest. I mean, why not? Just come on, just do that. And then we get to the other side of the crisis, then you get rid of that systemic risk exemption and you move on. So there's things I would do on the margin that are different, but in the grand scheme of things, I think they've done a good job, a very aggressive response to the problems.
Well, for everyone listening, we will know by the time this comes out. We're recording on Monday. The Friday it comes out, we'll hear from the Fed, I think, between then.
Yeah.
But just about the deposit insurance. This seems to be a sort of a hot button issue, right? People are, I think, tired. Many people seem to be tired of quote unquote bailing out banks. And I know you're not a politician, but can you help us understand? And I know this is a little different there.
I watch the politicians on TV, so
yeah, exactly,
I can play one.
Yeah.
I can play one. Go ahead.
So I know that, technically, just so everyone knows, what the FDIC has done is not bailed out the shareholders of Silicon Valley Bank or the bond or the credit holders. They are making whole any depositors who had some deposits at risk. But can you just tell us about sort of from an economics perspective, like what is the rationalization for doing this when some people could argue that, the bank was risky, they weren't doing what they should have shouldn't have had proper risk management. Like, why are they getting some sort of special treatment, and why is that necessary in the mind of the FDIC? And it sounds like you agree with it.
Yeah, in the current environment, which is, I think we can all agree, confidence is very brittle. People are on edge. Again, I'm getting questions from my mother-in-law about is her CD safe? That's the question I'm getting. That gives you a sense of the level of angst out there. I think we're what I would call a systemic environment, meaning there is risks of bank runs of the system, problems cascading throughout the system and taking the entire system out. So if you that's a judgment call, but if you buy into that judgment, then you're saying to yourself, okay, how am I going? What's the least costly way to do this so that it doesn't cost taxpayers money or cost them less? So if I say I'm going to make all these depositors whole of these failed institutions, the cost there is relatively small, and maybe to taxpayers directly nothing, because those deposits are going to be paid out by the banks. There's a deposit insurance fund. They pay into the FDIC deposit insurance fund for times like this, and that money that they pay into goes to the depositors. Now, you could say, okay, well, the banks are going to raise lending rates and lower deposit rates, and ultimately taxpayers are going to pay. Maybe, maybe not. Maybe it comes out of earnings. Maybe it comes out of bank CEO pay and bonuses. I'm sure it's all of the above. But the bigger question is, if you don't do that, back to my judgment, then you're risking the entire system, and then the cost to taxpayers is going to be measurably greater, and it's going to be a direct cost to taxpayers. It's going to overwhelm potentially the FDIC's insurance fund. So it's just a question of, how do I? This is a mess. There's going to be a cost, and what's the best way to resolve this and keep the cost down as well as possible? And in my mind, again, it's a judgment call, but in my mind, and I think in the minds of the folks that made this decision, the Treasury, the Fed, the FDIC, that this is the least cost way of going about doing it. And by, as you pointed out, it's not bailing out. The shareholders getting wiped out. And if they own shares in these banks, they're getting wiped out. If they're bondholders, I don't know. We'll see. But I suspect, if they're not wiped out, it's pennies on the dollar. So it's not like you're. The executives are out of. They're gone. They've left. They're not. They're not at the bank anymore. So you're not bailing those guys out. If you're bailing out anyone, it's you and I. We're bailing each other out. So I'm all on board. If you want to call it a bailout, go ahead. But I'm on board with that kind of bailout.
Got it. That makes a lot of sense. Thank you for explaining that. So I want to move on from the banking situation itself and sort of like the direct things that are happening there, and try and understand what some of the second order implications are here. First and foremost, how do you see this? You've told us a little bit about the Fed. You think that they shouldn't raise rates now. We'll see what happens there. How do you think this could impact the broader economy?
It's negative. It's just a question of how negative. The primary channel through what is going on in the banking system to the economy is through credit. Banks make loans to businesses and households. And because the banks are now under a lot of pressure and scrambling, they're going to be much more cautious in giving loans to banks and to businesses and households. They were already turning cautious. There's a lot of nervousness about the economy and recession risks, understandably so, given the high inflation and the run-up interest rates. And so if you look at lending standards, they had already started to tighten those quite significantly. So loan growth hadn't really slowed a lot, but it was going to slow anyway. Now with this, the banks, particularly the mid-sized and smaller banks that are under tremendous pressure, are going to be much more cautious in extending out credit. Auto loans, personal finance loans, business loans, C&I loans. The commercial real estate market's going to take it on the chin. The multifamily lenders were already struggling to get credit, to start new multifamily property development, later in the year. They're building now because that reflects the underwriting environment back 6, 12 months, 18 months ago. But a year from now, lending development is going to be significantly curtailed by the lack of credit, which is now only going to get worse by, this mess. Just to give you context, if you look at the banks that are less than $250 billion in assets, let's call those mid and small banks, They account for about a half of all C&I loans, commercial and industrial loans. Those are loans from banks to businesses. They account for about half of all consumer loans. That's credit cards and unsecured personal lines. They account for almost 2/3 of CRE, commercial real estate loans. So they're a big deal. And if they're pulling back on the availability of credit, then we see less lending. Less lending means less economic growth activity, less spending, less investment, less hiring. And so it's a weight on the economy. Now, there's going to be some offset to that from the lower rates. And this goes back to what I was talking about the Fed. I'm saying, hey, Fed, given what's going on here, that's worth at least 1, 2, 3 quarter point rate hikes. So why don't we just, pause a little bit here, take a look around, see what kind of damage this does. And then inflation, if it's still an issue 6 weeks from now, that's when you meet again, you start raising rates again, But let's make sure the financial system's on solid ground. But we have seen some decline in a little bit on the margin in terms of mortgage rates. Not a lot, a little bit, not as much as you would think given the decline in treasury yields. And we can talk about that. Corporate lending yields have come down, ever so slightly. So maybe we get a little risk on the interest rate side, but the tightening and underwriting is going to overwhelm that. So the net of all of that is it's going to slow economic activity, all else being equal.
I want to get to the real estate part in just a minute, but you've been pretty vocal about what you call a slowcession. And so I'd love for you to just explain that to our audience if they're not familiar with that. And I haven't heard since this crisis if you think that the banking situation has altered or changing to your forecast of a quote unquote slow session.
Yeah, this is about the economic outlook, and the prevailing view at the moment is recession. The economy is going to experience a broad-based, persistent decline in economic activity. I don't think that's necessarily our future, but I don't like the alternative description, soft landing. This isn't going to be soft. As we can see, this is going to be a bit harrowing, as we come into the tarmac. And so I didn't like the soft landing description. So slow session seems to fit. It's not a recession, but it's an economy that's not going anywhere. It's very slow, sluggish, kind of flat line. And that's the economy that I have been expecting, to unfold here over the next 12, 18, 24 months. Under any scenario. That was before the banking crisis. And I still think odds are that's what's going to happen here. The economy is amazingly resilient. We can talk about, that too. But I think that resilience will pay off. But having said that, I say it with less confidence today for sure because of the banking crisis. So the odds that I'm wrong are definitively higher today than, 2 weeks ago before this mess occurred. So I still think, I have lowered my growth projections, 2.3-4% in terms of real GDP growth over the next year. GDP is the value of all the things we produce. In a typical year, you grow 2%. So if you shave 2.3-4%, that's meaningful. So you're going to feel that, but it's still not to a place where we actually go into recession. But having said that, again, I'm not as confident. Having said that, the script is still being written, right, as we speak. So we'll have to see how this plays out.
So in your mind, the slow session, we would see GDP growth, just some modest GDP growth, just under that 2% normal.
Yeah, maybe
rate.
0 to 1, basically going nowhere, flat line, flat. And in that world, you probably might see some job loss, certainly no much job growth, and you would definitely see unemployment rise. So unemployment would go from very low 3.6 to something north of 4 over the course of the next 12, 18 months. So again, that doesn't feel like a soft landing. That feels very uncomfortable. But again, not a full-blown outright recession, which typically would mean we lose 5-6 million jobs. Unemployment goes to 6%. I think we can avoid that. But I say again with less confidence, and we're now even more vulnerable than we were before. We're weaker, and if anything else comes off the rails, any other wheel falls off, then very likely, and I can think a lot of things. Debt limit. It's coming up here in the next few months. There's a lot of things to worry about out there that could do us in.
Yeah, that definitely. There's the overwhelming media narrative that you see is just, mostly negative about the economy. In our industry, people listening to this, mostly in the real estate industry, it's been a really tough year, last 6 to 12 months. So curious, what are the areas of the economy that you say are resilient and that you believe will help keep this U.S. out of a recession?
Well, the obvious, businesses don't want to lay off outside of tech. The tech's laying off, but those folks, at least so far, they're getting hired pretty quickly by other companies that have been starved for tech workers for a long time. So they're not even showing up in the unemployment insurance rolls. They get laid off, and they're ending up somewhere else. They're not going to the UI getting unemployment insurance. And I think it goes to the fact that labor markets have been very tight and will continue to be very tight going forward. Just demographics, the aging out of the baby boom generation, my generation, me. I'll never leave, Dave, but
we need you.
And weaker immigration for lots of reasons, and that's key to our growth in the labor force. So labor markets are tight. So businesses thinking to themselves, look, it's going to be real on the other side of whatever this is, recession, slow session, whatever. If I think fast forward 18, 24 months from now, I'm going to be back to how do I find people and how do I retain people? And I'm not going to make that worse by laying off workers now. Now I may, and I am expecting that they hire less, right? So, you have natural turnover, and right now turnover is a little elevated from where it was. People have been quitting their jobs at a higher rate, although that's coming in. That creates an open position. But businesses aren't filling those open positions quickly. They're slow walking their hiring. So that way you can manage your payrolls, your labor costs without laying off workers. And if you don't lay off workers, if we don't see significant layoffs across the economy, I don't think we get a recession, because you need those layoffs to go back to what we were saying earlier about psychology, to scare people saying, oh my gosh, I'm going to lose my job, or I lost my job, or my neighbor lost their job, or my kids lost their job, and I got to help them out. And then you pull back on your spending, and that's a recession. Everyone running into the bunker and stop spending. But if you don't get the layoffs, it's harder you can get there, I suppose, but it's a lot harder to get there. And that's a fundamental difference, what I'm just described in the labor market, job market, than any other time that I'm aware of, historically. So very, very different kind of, backdrop. I can go on, but that's I think a very clear reason why I think the economy is resilient and can be able to kind of navigate through some of these hits without going into a full-blown outright downturn. Does that make sense?
That's super helpful. I'm just curious. Yeah, it does. I'm just curious what other economists, as so many people are forecasting a recession, see differently.
Well, okay, I can do that too, Dave.
But yeah, let's see the devil's advocate side.
I can do that too.
Let's do it.
Well, all right. I mean, it goes back to psychology. And then what happens is the economy weakens. You start getting more layoffs in the construction trades, which we haven't seen yet. For example, you see more manufacturing layoffs. The labor market starts to ease up. Unemployment starts to rise. And then some businesses say, oh, maybe it isn't going to be so hard to find workers, and it isn't going to be so hard to retain them. And by the way, I'm really worried that, I've got these high labor costs and no business. I'm losing money, cash flow, and I'm going to cut. And then the layoffs become self-reinforcing. People see layoffs and more people out there looking for work. They become less concerned about their tight labor. It kind of feeds on itself, and then you get the layoffs, and then you get the pullback in spending, and then you get the recession. So it's kind of one of the metaphor. I'm not sure what it is. Is like you're bending a piece of metal. That's the economy. All these pressures that they're bending, and I'm saying it's not going to break, but you get to a place, some point, it breaks, right? That's kind of how I think about it, in a kind of a metaphysical sense.
Okay, great. That was good devil's advocate. I appreciate it.
There you go.
It's
I told you I could do it.
Both sides. And I mean, obviously, I think as an economist, you probably say this all the time. Like what you're describing is you're telling us what you think is the most probable scenarios, but it's not like other futures are impossible.
There are many possible futures. And again, the risks here are very high, uncomfortably high. So yeah, in fact, that's what I do for a living. It's about kind of the scenario in the middle of the distribution of possible outcomes. But for most thinking business people, it's about the whole panoply of possible outcomes, and how do I think about navigating in those different worlds, and what kind of probability should I be attaching to those different worlds. So it's not about one scenario. We all kind of fixate on that. It's about this distribution of possible outcomes.
I love that. I think that's so important for people to understand that when anyone gives honest person gives their opinion about what might happen in the future, not just saying this is definitely going to happen or, this is the way it is. People are trying to understand the different possible outcomes and tell you what they think the most probable outcome is. But obviously anyone who's honest knows that their forecasting is not always going to be correct.
We all do that. We all forecast. This is something people say, I don't like to forecast. Well, everybody on the planet's forecasting all the time. And that's exactly, people don't think about it, but that's exactly what they're doing. They got, this is what I think is going to happen, but it could be this, it could be that. And I'm going to think about the range of possibilities and how I would behave and navigate given those different possible outcomes. So everyone is kind of sort of doing that. Economists just make that process explicit as explicit as they can.
Well, you've done my job for me and done a great transition into the last thing I want to talk about, which is, of course, the real estate market. And you've hit a bit on commercial real estate and how you think at least funding for new projects might get hit. But I'm curious, what are some of the scenarios or more probable scenarios you see both for commercial and the residential real estate markets?
Well, I think the single family side, where I spent a lot of my energy, obviously that's gotten crushed in terms of housing demand. Home sales are back to kind of levels you don't see since in the middle of the pandemic or in the financial crisis. Single family housing is already in recession. I will say I think the worst is over in terms of sales. I don't think they're coming back fast until affordability is restored, and that requires some combination of lower rates, higher incomes, and probably some house price decline. So I do expect more house price declines here over the next couple of years. In fact, our baseline kind of in the middle of the distribution is for a 10% roughly peak to trough decline in house prices, from the last summer through probably the end of 2024. So I think single family, the worst on sales, and we're getting pretty close to the worst on construction, not quite there yet, but we got more to go in terms of house prices. Multifamily, as you know, has been, rip-roaring great, but I do think it's going to have a comeuppance here. It's already started in terms of rents because you have more supply coming into the market. Demand has been hurt because rents are just too high. Not only is it unaffordable to own a home, it's unaffordable to rent as well at this point. And so you have a weaker demand and more supply. Vacancies are going to start to move north, and that's going to keep pressure on rents. And I do think we're going to see some meaningful weakening in new supply down the road, given what I just said about underwriting and tightening of lending. And I do expect some price declines. Prices are pretty high, and I do expect some adjustment there. But on the rest of CRE, I don't want to paint with too broad a brush, but I think it's pretty fair to say office has got a big problem, particularly big city, urban. Those towers, remote work is here to stay. It's not going away. There's been some swinging back of that pendulum, but as technology improves and as new companies form and optimize around remote work, and they will not optimize around an office space, we're going to see weakening demand. And by the way, going back to my point about demographics, one of the implications of that, very little job growth, going forward. We're going to get, we've been used to 100, 200, 300K per month. I think everyone needs to get used to 50K per month, 25K per month. And that goes to absorption, right, of office space. So I think office has got some serious adjusting to do, particularly again, I'm painting with a broad brush, but particularly in those big urban centers. Retail is centered in those urban areas. They got problems because they cater to all those office workers. I think industrial probably, that actually got a big lift during the pandemic because of all the movement of goods and services. Yeah, I think it's still going to be fine, but probably somewhat diminished on the other side of all that. But generally speaking, I think real estate's going to be, in terms of residential and CRE, is got some adjusting to do. There's going to be some adjustment here over the next couple, 3 years in terms of everything, prices and rents and everything. Some further adjusting to do. It just depends on the property type, location, just how significant that adjustment will be. That's a whole podcast in itself, Dave. There's
many podcasts. Yeah, well, it keeps me a job.
Yes, right. Yeah.
Yes, it definitely does. But it's super helpful to know. And yeah, commercial's its own thing, but I think the majority of our listeners are mostly involved in the residential space.
Oh, is that right? Okay.
Yeah. It sounds like you think, we are in a correction, but it's not like a bottom falling out kind of situation where prices are going to go into some sort of nosedive, more single digits, maybe 10-ish% declines.
I don't think. I mean, I would say that the best of times are over. I mean, those were, pretty darn good times not too long ago.
In terms of like price appreciation?
Yeah, and rents, everything was going north, and that's over. You got a lot more supply coming into the market. Vacancy rates have hit bottom and start to rise. But I would agree that, and I think you're going to have opportunity, if you have cash, you should, because I think prices will come down for lots of multifamily rental property, and you'll have an opportunity to step in at some point. But I do think in the longer run, it's going to be a good investment because fundamentally what really matters is home ownership. And I'm talking now through the business cycle, 10 years, 20 years out. If you look, home ownership is going to be under pressure. So the home ownership rate is going to decline, which the flip of that means, higher proportion of the population is going to rent, over the next 10, 20 years. So I think that fundamental support to the market will prevail over a long period of time. But in the near term, there's some adjusting to do. But again, if you have cash, I view that as an opportunity because prices have gotten way too high. I don't know about. I look at a lot of these, properties. If you do the kind of the basic Excel spreadsheet thing, you couldn't make it work really.
No.
You had to really stretch the imagination. You couldn't convince a bank maybe they're. Tell me where that bank was. So I'm not sure what they're doing now. But now so once prices come back in, then some of these spreadsheets will start working again.
Yeah, I mean, absolutely. You're looking in commercial where the cap rates are lower than interest rates on a risk-free asset. You can do better on a 10-year treasury, even two-year treasury, than on buying a multifamily, and the treasury is a lot less risk than the multifamily. So something has to change there. Totally.
Well, as we know, Dave, looking at the banking system, you have to sell it before it matures. That could be a problem.
There you go. Yeah, that's the lesson. That's the lesson we've learned.
Or please hedge it. So.
Yeah. Yes. Please.
Yeah.
The last question I want to ask you before we let you get out of here is you said something about mortgage rates and that, bond yields have dropped over the last couple months or weeks, excuse me. And mortgage rates, you said, hadn't declined as much as you would have thought. So I'm curious if you could just give us your take on mortgage rates right now and where they might head over the course of the year.
Yeah. The mortgage rate, the 30-year fix is roughly equal to, in the way I think about it, the 10-year treasury yield plus a spread. The spread is a function of lots of stuff, origination costs, servicing costs, if it's a Fannie Freddie loan, a G fee. And then there's also the compensation that the investor in the mortgage needs for prepayment risk, the risk that they get paid back early. And that prepayment risk is elevated when you have a lot of volatility in rates. And you have, as we know, a lot of volatility in rates. So that spread is very wide. So the 10-year treasury yield today is 3.5%. The 30-year fix is 6.60, something like that. That's a 310 basis point spread. Typically, long run, it's 150, 175 basis points. So that gives you a sense of magnitude. It's going to stay elevated like that as long as the environment remains as uncertain as it is, until it's clear the Fed is done raising rates and that we know when it's going to start coming back down. They're going to start coming back down to earth. So I expect 6.5, 7, here, until that happens. That won't happen for another 3, 6, 9, maybe 12 months. It eventually will. But I'll leave you with, in the long run, when everything kind of settles down and where things go to where they should be, which by the way never happens. But let's theoretically let's just go with that. 30-year fixed rate mortgages should be 5.5%. That's where they should be going. So they're elevated now by 100 or 150 basis points, something like that. That's that spread I talked about. Does that make sense? What I just said?
Yes, it does.
Yeah.
And just reinforcing for anyone who is waiting for those 3 or 4% interest rates to come back, you're going to be waiting a long time.
It could happen, but that's a recession. And, then you're in that recession scenario. That it's possible, but yeah.
Okay, great. Well, Mark, thank you so much for being here. This has been fantastic. I learned a lot, and this has been a lot of fun. If anyone wants to learn more about you or follow your work, where should they do that?
They can go to economy.com. I have that URL. I bought it before I sold my company to Moody's. So we've had that URL for a long time. And you can learn a lot about us there. And we've got this cool website called Economic View. And, feel free. Oh, I did want to plug one thing.
Yes.
Inside my own podcast. Dave, I got to have you on my podcast. I got the podcast. Yeah.
I would love to.
Inside Economics. Yeah, you should take a listen. It's the funnest thing I do all week.
Can you just tell us a little bit about it?
Yeah, it's you got to be a little nerdy because it is Economist, and I do bring on, like last week I had Aaron Klein on. He's a very well-respected fellow of economic studies at Brookings Institution that focuses on financial institutions and markets. He was he was a chief economist of the Senate Banking Committee. He was in Obama's Treasury, so he lived through he actually did a lot of work on TARP. You remember the bailout plan?
Yep.
So he knows banking inside out. In fact, he's a really interesting guy. But when he started reading from the 1933 Banking Act, I go, "Hey, Aaron, what the heck?"
Mark, you're not selling this podcast.
Yeah, no. You got to be. Hey, I got a great statistics game that people love.
Okay,
but great guests, a lot of fun. People will enjoy it. Yeah, people will enjoy it. At least I do. It doesn't matter. It's almost I don't really care what people think.
No, that's the kind of stuff I really like, and I think we've all learned over the last few years how much economics matters and how much it impacts everyday life and things that you don't even know that it impacts. So learning about these things is really helpful, and I will definitely be tuning in. Well, Mark, thank you so much for being here. We appreciate it, and hopefully we'll have you on again sometime.
Thank you so much.
Thanks again to Mark Zandi, Chief Economist of Moody's Analytics, for joining us for this episode of On the Market. I hope you all learned as much as I did. I found that show super fascinating. I think Mark does a really good job giving context and backgrounds about his opinions. And, I think that's really important when you listen to anyone, specifically and particularly economists. Everyone has opinions. And as we talked about in the show, Mark or anyone, me, whoever else is talking, is really trying to give you the thing they think is most probable to happen. They're not saying this is definitely going to happen or this is the right thing to do, this is the wrong thing to do. They're basing their information and opinions on probabilities. And I think Mark does a really good job of explaining his thinking and some of the context that goes into why he thinks certain things are really important and which indicators are really important to follow, which ones are less important to. So I found this super interesting and very helpful in adding some context to my own thinking about the economy and my own thinking about my real estate portfolio. If you have any questions, thoughts, or feedback about this episode, we always really appreciate that. I know we say that, but we really do. So if you have any comments, you can always find me on Bigger Pockets or on Instagram, where I'm at The Data Deli. If you're watching this on YouTube, make sure to leave us a comment or a question there. We do our best to get back to you. Or if you found this one particularly interesting, we always appreciate a review on either Spotify or Apple. It really does mean a lot to us. Thanks again for listening. We'll see you for the next episode next week of On the Market. On the Market is created by me, Dave Meyer, and Kaylin Bennett. Produced by Kaylin Bennett. Editing by Joel Esparza and Onyx Media. Research by Pooja Jindal. And a big thanks to the entire Bigger Pockets team. The content on the show On the Market are opinions only. All listeners should independently verify data points, opinions, and investment strategies.